Hi, everyone. Thank you for joining us today for our latest case study. My name is Andrew Paolillo, and I'm the Director of Member Strategies and Solutions here at the bank. And today we're going to take a deeper dive into the strategy of selling seasoned, lower coupon mortgages that your bank or credit union has originated and retained over the last few years. So we'll start off by looking at call report data and seeing how much of the total loan portfolio residential mortgages account for. And we'll break that out by banks and credit unions. And as a note, we're looking at just our members here in New England, not national averages. So when we look at the trends over the last few quarters, we can see that banks have actually seen some declines in residential mortgages as a percentage of the loan portfolio, while credit unions have done a little bit better job of seeing modest increases in how much of the 1 to 4 family loans make their way onto the balance sheet. Now, this is interesting because if there's been one common thread that we've heard from members over the last few months is that given the excess liquidity conditions, that they've been holding more and more origination than what they typically would see. But when we look at the numbers here and see that the net growth is either not there or in the case of credit unions slightly there, that tells us that despite retaining the origination, the elevated amount of prepays has offset the intention to hold more and more mortgages with the goal of sopping up some of that excess liquidity. So with high amounts of prepays, naturally we'd expect to see some downward pressure on loan yields, and that's exactly what we have. So what we're looking at here is yields on residential loans over the last few quarters. For banks, credit unions, call reports do not break out yields by loan type. And what we have seen is that over the last few quarters, yields have come down on a portfolio basis by about 50 to 75 basis points. And even those folks who are doing relatively better, in the 75th percentile, still sub 4% on what's left in portfolio. So if we're talking about retaining fixed rate mortgages on the balance sheet, it's instructive to compare those rates and spreads versus the mortgage-backed security alternative. So what we have here is in green, the 30-year primary mortgage rate, and the blue line is a 30-year mortgage-backed security structure. And then the big green on the bottom, that is the spread between the two. So we rewind to the second half of 2020 when primary mortgage rates broke through 3%. The alternative for investing that excess liquidity into bonds didn't even get you to the 1.5% yield level. So said another way, spreads on mortgage loans were relatively wide. As we moved through 2021, mortgage rates began to tick up a little bit higher, and then most recently in the middle of this year, dipped back down below 3%. But what was different in 2021 versus 2020 was that primary mortgage spreads were tightening. So we can see, we were at that same 275 level or thereabouts, but now mortgage-backed security yields were higher by about 40, 50 basis points. So the trade-off between loans and bonds was that spread was tightening. So right now we're closer to 100 basis point differential versus the 150 basis points and higher that we saw in 2020. Now we can look at the yield curve, or more specifically, the steepness between two different parts of the yield curve, as proxies for the different decisions depositories have to make in terms of deploying the asset side of the balance sheet. So the blue line here shows the spread between the 1-month and 3-year Treasury, and that we use as a proxy for sitting in cash and deciding how much or realizing how much compensation we can get by moving into bonds. And the green line is the 5-year, 10-year spread. And that we use as a proxy for how much added compensation we get from moving from bonds into longer fixed rate mortgages, similar to what we were talking about on the last slide. And you can see the path of these two metrics have been on a decidedly different trajectory over the last few months. So the blue line, the 1 month, 3 year, the proxy for cash to bonds, has been trending higher. And that's attributable to the timeline for Fed hikes being pulled forward considerably over the last few weeks and months. So for those who have been sitting in cash, because the alternatives and options for deploying that excess liquidity weren't particularly appealing, well, now you have some much more attractive options relative to just a few months ago. Now, at the same time that the front end of the curve has been steepening, the long end has been flattening. It seems kind of counterintuitive with all the talk about inflation going on, but long rates have been declining faster than the intermediate rates. So the incremental yield that one gets from moving from 5 to 10 years is only about 23 basis points. Compare that to in the beginning of the year, where it was 84 basis points at its high, much more beneficial. Now, like we said, depositories have had options on deploying that excess liquidity, and here are the three primary buckets that you would think about when deploying that excess liquidity. So let's move left to right. Very simply, reserves, cash is pretty simple and straightforward, but it comes at the opportunity cost of earning 15 basis points as opposed to moving out the curve into other instruments that will produce greater amounts of income. Investments, we've seen a considerable growth for banks and credit unions over the last few quarters in growing the investment portfolio. And it tends to be a nimble and flexible option because there is no one-size-fits-all in that slice of the world, that you can calibrate the amount of risk and the amount of return that you take depending on the types of investments and the amount of investments that you look to add. And it does offer flexibility with the held to maturity designation, and also many investments that depositories tend to gravitate towards do have the potential to be pledged to the bank and can add to your collateral capacity, which supports liquidity calculations. Lastly, on the right is mortgages, what we're here to primarily focus on today. And relative to cash and investments, it certainly is the highest yielding option. But let's do a little bit of a three-pronged shock analysis and say, well, if long rates go higher, these assets aren't going to perform particularly well because they have a very long duration. In fact, would be prone to some extension risk and seeing their average lives push even further than the relatively long assumptions where they're set at right now. In a flat rate environment, yes, you're earning higher yields, but the spreads are pretty narrow, as we outlined a few slides back, and typically there'd be just a modest amount of cash flow. Now, lastly, falling rates, while long duration should perform pretty well if rates were to fall, right? Well, that's not necessarily the case, because we all know mortgages have the prepayment risk and the contraction risk that these assets may pay off and leave the balance sheet, contributing to further margin contraction down the line. So what can we do? So let's get back to the title of the case study, selling seasoned lower coupon loans. So through our MPF traditional program, which is a secondary market outlet for members, loans with coupons below 3% have recently been priced just slightly above par. Now, that's not the typical 2 to 4 points of premium maybe that you would target in a secondary market transaction, but it's important to note that that's typically on new origination, not on seasoned loans where you've already earned the coupon or the carry for a period of time. So as we'll see in the next slide, the total return from that loan can often be comparable to if you had sold it originally. And it's helped solve the problem of having excess liquidity over the last few months. So in some regards, it has accomplished that. But as loan demand is picking back up, as the yield curve is steepening, which changes the appeal for investments, as we saw in a previous slide, there may be more efficient uses of the left side of the balance sheet. So we outlined some of the potential options to take the proceeds and redeploy them. So originate higher coupon mortgages. So if you think of a scenario where if your current rate that you're offering to customers is 3.25, if you're able to sell a 2 7/8 loan at slightly above par and use those proceeds to originate 3.25 loans, you have kept the same asset or the asset type, but you've done it at a 37 basis point wider spread. So more return for the same amount of risk. The second bullet there, the meet commercial or consumer loan demand. As the economy has worked its way out of the depths of the pandemic, we have seen signs, both quantitative and qualitative feedback from members of loan demand, customer loan demand coming back and improving. So all things being equal, there may be more opportunities to deploy loans in more targeted sectors than simply retaining fixed rate mortgage origination. As we talked about, the changing dynamic in spreads in mortgage-backed securities, that give up from going from the loan rate to where you can turn around and buy bonds with the proceeds, that spread is considerably tighter than where it has been. And then lastly, the conventional investment profile, maybe the 30-year mortgage-backed security is not your typical type of investment. But as we mentioned when looking at the shape of the yield curve a few slides back, the compensation to go to that 3-year, 5-year part of the curve looks an awful lot better, and that being the typical area where depositories would gravitate. Again, that looks more appealing than it has been in recent months. So let's look at a comparison of two different approaches one could have taken when originating mortgage loans back in late 2020. So the blue line is a strategy of selling those loans immediately at a premium of 3 points and reinvesting into a 5-year bond. The green line is a strategy of originating and holding that mortgage on the books for a period of 1 year, which brings us to the present day, selling the loan at a slight premium, and then reinvesting into a 4-year bond to make it an apples-to-apples comparison versus the maturity of the blue line. Now, what we see is that the blue line, the sell immediately, obviously gets the benefit of the big premium up front, whereas the retain then sell strategy sees the income received over that first year gradually build up, a slight bump from the slim premium, and then growth continues again from the proceeds of the bond. And in fact, it's about at the 1.5-year mark where the cumulative income earned for the retained and sell strategy begins to outperform the sell immediately. Now, it's worthwhile to point out the impact of changing rates that this may have on any held mortgages on the books. So let's think about what happens in a down rate scenario, as we talked about previously, that there's the potential for these retained loans to be prepaid, and then the prospect of continuing to receive income off of them or even sell at a premium, big or small, goes away if that loan is prepaid. Alternatively, if rates were to go up, yes, you continue to receive the income on the loan, but as mentioned a slide or two back, there's the extension risk and the fact that the spreads received are relatively narrow and less than favorable in a rising rate environment. Now, you may or may not be familiar with our MPF program, in particular the MPF traditional product. So now if you have some interest, please reach out to your relationship manager. We'd be more than happy to discuss in more detail. But there are two quick points that are worthy of being pointed out. One neat feature of the product is that you do get current production pricing on any loans seasoned up to 24 months. Secondly, the credit enhancement fees are a distinguishing feature versus other secondary market outlets. Because when you sell a loan to the bank, and as the loan continues to perform, we share some income back with the member. So what you earn over time from that one loan goes beyond just the price that you receive upfront upon the completion of the transaction. So that brings us to the end. Thank you for your time. Hopefully you found something here to be useful or interesting. And as always, if there's anything that we can be of help with, please reach out to us and we'd be more than happy to discuss. Thank you very much.